Good afternoon. Welcome to Kenya News Update today. I'm your host, and we're diving deep into a topic that affects millions worldwide: the financial habits that keep the middle class running in place. While headlines today focus on breaking news, from explosions reported in Iran to immigration policy battles in Minnesota, there's a quieter, more pervasive struggle happening in households across the globe. It's the struggle to build wealth, to escape what's often called the rat race. Today, we're not just reporting the news, we're analyzing the patterns behind it. We'll present a compelling case about 5 specific middle-class habits that financial experts argue are major barriers to wealth accumulation. But we won't stop there. We'll also debate this perspective, bringing in counterarguments about systemic economic pressures, the value of stability, and whether this framework places undue blame on individuals. This is a 12-minute deep dive into the economics of everyday life. Let's begin. The core argument, popularized by financial commentators and platforms like New Trader U, is stark. The path to wealth isn't hidden behind complex Wall Street strategies. Instead, it's blocked by daily, socially approved behaviors that feel responsible, but are financially limiting. Proponents call this cultural programming, an invisible ceiling crafted by social expectations. They identify 5 key patterns. We'll examine each one, complete with data, and then hear the rebuttal. First on the list, the over-reliance on a single income. The traditional model of one primary breadwinner supporting a household is presented as a critical vulnerability. Advocates for change argue that in an economy where 78% of American workers, for example, live paycheck to paycheck according to a recent Career Builder survey, having all financial eggs in one basket is dangerously outdated. The proposed solution? Developing multiple streams of income. This could mean a side business, freelance work, or investment dividends. The data point often cited is that the average millionaire has 7 streams of income. The visual here is powerful, a single precarious pillar versus a diversified foundation. But critics push back hard. They ask, where is the time? With the average full-time work week hovering around 47 hours globally and childcare costs soaring, often consuming 20% of a middle-class family's income, the capacity to build a side hustle is a privilege, not a choice. They argue this advice ignores the reality of burnout and the value of rest. Next, habit 2, trading time for money. This is the classic employee mindset: you exchange hours for a fixed salary. The ceiling here is obvious: there are only so many hours in a day. Promoters of wealth building insist the goal must be to decouple income from time, to build assets that earn money while you sleep. Think rental properties, intellectual property like books or courses, or scalable online businesses. They point to tax structures that favor investment income over earned income. In many jurisdictions, long-term capital gains are taxed at a significantly lower rate than ordinary income. For instance, the top U.S. federal rate for long-term capital gains is 20%, compared to 37% for ordinary income. This creates a built-in advantage for wealth built on assets, not labor. The counter-argument from labor economists and sociologists is that this framework demonizes stable employment, the very thing that provides healthcare, retirement benefits, and societal stability. They argue that not every job can or should be scaled. Society needs teachers, nurses, and engineers who are paid for their time and expertise. The solution, they say, isn't for everyone to become an entrepreneur, but to ensure jobs pay living wages and offer paths for advancement. The third habit is perhaps the most culturally ingrained: the pursuit of lifestyle inflation. As income rises, spending rises to meet it. The new car, the bigger house, the upgraded vacations. Financial advisors call this the hedonic treadmill. You run faster but stay in the same place financially. The statistic often used is that approximately 70% of lottery winners go bankrupt within a few years. Their habits, not their income, determine their fate. The visual is a chart showing income rising in a steady line, but net worth remaining flat as consumption rises in parallel. The antidote, according to this school of thought, is stealth wealth, living well below your means and aggressively investing the difference. But social psychologists and cultural analysts offer a different view. They argue that consumption isn't merely frivolous, it's a social signal. It provides status, belonging, and even mental well-being in a consumer-driven society. Furthermore, spending drives the economy. If everyone adopted extreme frugality, aggregate demand could plummet. The debate here is between individual financial optimization and the social and economic functions of consumption. Habit 4, an excessive focus on saving, not investing. The middle class is often praised for its discipline in saving money. But the argument goes that parking money in a low-yield savings account, while safe, is a losing battle against inflation. With global inflation rates averaging between 2–5% in stable economies and savings account interest often below 1%, the purchasing power of those savings erodes every year. The prescription is to become an investor, not just a saver. This means allocating funds to the stock market, real estate, or other appreciating assets. The power of compound growth is the hero here. A simple chart showing the difference between 50,000 Kenyan shillings growing at 1% interest versus 7% annual return over 30 years is staggering. The 7% portfolio could be worth over 4 times as much. The opposition to this point is rooted in risk and history. Critics remind us of market crashes, from the dot-com bubble to 2008. For many middle-class families, their savings represent security against medical emergencies, job loss, or educational costs. Losing that in a volatile market is catastrophic. They argue that promoting investment without acknowledging the very real risk of loss is irresponsible, especially for those without a significant financial buffer. The fifth and final habit is seeking formal education over financial education. The narrative is that the middle class prioritizes degrees, often taking on substantial student debt, while neglecting to learn about taxes, investing, credit, and asset protection. The data on student debt is compelling. In the United States, total student loan debt exceeds $1.7 trillion, a burden that delays home ownership, retirement saving, and wealth building for millions. The alternative proposed is a dual focus, gain practical skills, but simultaneously dedicate time to understanding personal finance and wealth building principles. The pushback here is fierce and multifaceted. First, formal education remains one of the most reliable predictors of higher lifetime earnings. Second, it develops critical thinking skills applicable beyond finance. Third, critics argue that the financial education being promoted is often a gateway to selling specific products, courses, or a libertarian ideology that downplays the role of public goods and social safety nets. They ask, is the problem a lack of individual knowledge, or is it a system with predatory lending, stagnant wages, and complex, loophole-ridden tax codes that benefit the already wealthy? Now, let's zoom out and synthesize this debate. On one side, you have a powerful, individual-centric model of empowerment. It says the rules of the wealth game are knowable, and you can opt out of the rat race by changing your behavior. It's optimistic and action-oriented. On the other side, you have a systemic critique. It argues that focusing on habits ignores monumental structural issues, wealth concentration, the rising cost of essential services like healthcare and education, and the decline of unionized, stable employment. From this view, the rat race isn't caused by bad habits. It's the logical outcome of an economic system that requires constant consumption and debt to function, while asset ownership becomes increasingly concentrated. So where does this leave us, the viewer? The truth likely lies in the intersection. Personal responsibility matters. The principles of living below your means, investing early, and seeking diverse income are financially sound. Ignoring them can be costly. But systemic forces are equally real. The fact that the top 1% of global wealth holders now own nearly 38% of all household wealth, according to the World Inequality Lab, isn't due to their superior budgeting skills alone. Tax policies, inheritance, and access to capital play enormous roles. Therefore, a complete picture requires both lenses. We must advocate for personal financial literacy and prudent habits while simultaneously demanding economic policies that make wealth building genuinely accessible, policies that address housing affordability, student debt, healthcare costs, and fair taxation. It's not an either-or, it's a both-and. To escape the rat race, we may need to change our own wheels while also working to repair the track itself. As we conclude, remember that while we analyze these global patterns, the world keeps turning. From geopolitical tensions in the Middle East to domestic policy debates in the United States under President Trump and economic developments here in Kenya under President Ruto, the connection between individual financial security and global stability has never been clearer. Thank you for joining this deep dive. What's your perspective? Are these habits the cage, or is the cage much larger? Let us know in the comments. For continued coverage of news that impacts your world and your wallet, subscribe to Kenya News Update today.